one were to argue, if you look at the GDP, it got reset. And one of the reasons why it got sort of moved up because from the universe expanded. And it seems to everybody that the universe which is below the radar is moving faster and better than the universe that we are seeing. So the tip of the iceberg seems to be moving in a much slower fashion. Which again, does it make the case for mid-cap stronger?
I think mid-cap is clearly always, in fact, small cap will do much better than mid-cap, which will do better than large cap over the long term. So that's not in dispute. In my opinion, that's proved globally across countries as well. Having said that, the problem what I have seen in my experience sitting in ICICI mutual fund has been, if you look at years like 11, 12, 13, those 3 years no money came into mid-caps. And 14, after a blistering rally in mid-cap funds have become very large. So the challenge is not with returns. If you look at what happened to mid-caps 2004 to 6, there was a huge boom in mid-caps. Then from 2006 to 13 almost, for 7 years mid-cap funds didn't grow much at all. Then 13 onwards they've grown in a blistering manner. So I believe that if you are genuinely long-term, small caps are possibly the best, followed by mid-caps. But having said that, your timing is pretty important. So if you say, I will invest in mid-caps only after mid-caps do well, then it's better you invest only in flexi-cap. Because what will happen is you will choose to wait for 2014 to invest in mid-caps. Today, when you look at the returns, you can clearly see mid-caps have done much better than large caps. Even though mid-caps have done much better than large caps, I don't think 5 years back people were investing in any mid-cap fund. So the challenge is not return. The challenge is that why is it that SIPs are not done in mid-cap funds? I think SIPs are much better in mid-cap funds. Mid-cap funds will go slowly for some period of time, then we'll have a big rally. And so I think the challenge is you have to do systematic investing in mid-cap. And second is if mid-caps go totally out of favor, you should be increasing allocation to mid-cap. And if mid-caps become totally in favor, like as it was last year, second half, then you should be careful in mid-caps. So that is the challenge actually. The challenge is for the asset, for the distributor and the wealth manager. For the long term, if I'm a fund manager in mid-cap, I'll be able to deliver better returns than large caps.
Prashant, on the interest rate side, what is a good way of playing interest rate? Is it played well? And I'm talking again from a financial planning, meeting a life goal perspective. Is it played well through government securities, gilt funds? Is it played better through, higher credit, or it is played better in any other way? For example, one of the things that we discovered was that instead of putting it in 3-year FMP, if you put it in liquid, actually you can create tax-free returns because you'll hold it for 3 years, with full liquidity instead of FMP. What is a good way of playing interest rate cycle? What is a good way of playing accruals?
I think, this is a very difficult question to answer, and because the nature of the asset class is such that you can't, you can generate or earn returns only in line with the nature of the asset category. And in fixed income, there is only a preponement or postponement of returns.
Yes.
So it is not that fundamentally unlike equities which grow over time and can create wealth. Here it is basically if interest rates fall, you get more today and your running yield falls and you get less tomorrow, and vice versa. So I think we should keep our expectations moderate from fixed income funds, and it is hard for anyone to over 10-year period to earn anything meaningfully different from what the category is inherently capable of. Having said that, I feel that since the primary purpose of coming in fixed income is less risk, if you want risk, you can go to equities and earn 15-20% CAGR returns. So if the primary purpose of fixed income is lower risk, I think to play interest rates is probably less risky than credit. Because even if I get the interest rate call wrong, at least in the next 3 years I will make it up. the money is not going anywhere. The running yields have gone up, and over time it will be made up through higher accrual. But on the credit side, if you make wrong calls, it can cause lasting damage. So I think while credit funds are also good, and we also have credit funds, but I think a limited portion of your money can go for credit funds. But I feel that bulk of the money should go to less credit risk corporate bond funds or to gilt funds.
Gopal, your view on this as an asset class, fixed income, because we must remember that we are again competing against tax-frees of the world. If somebody is at a lower tax bracket, then even bank FD is not a bad situation because you just have 10% going. So what is your view on playing fixed income from an asset management perspective?
See, the asset allocation is very key. As as earlier it was stated that the 90% of the return is made when you do the right asset allocation. So the fixed income, in my view, is more for regular income actually, when you are risk-free. So it should be taken as a certain percentage of the portfolio. And second part is that I am not very much in favor of credit funds actually in debt market, because if you are taking risk, better to play through equity, and if your returns can be much higher. Here you take risk and your return is limited, right? And that too, your risk is much higher actually, right? So my suggestion would be better to play through accruals, or if you are risk taker little bit, then the GSEC funds are better. But I am not very advocatory of the credit funds.
Nothing on rebalancing and exit is not a full exit, but exit in a way of rebalancing. What are your learnings on rebalancing? Should advisors have triggers for rebalance? Because these are forward looking. It's very difficult to have those triggers because only in hindsight we become wiser in these things. Or you think that it should have an automatic rebalancing, that if equity you started off with 50-50, equity grew, you just take it out mechanically and put it back as debt to again make the same allocation? Or are there any good practices that you have as fund manager, because you have to also rebalance your own portfolios, within stocks though, or within other fixed income?
My experience was shaped by 2007, 8, 9. In 2007, it was difficult to convince people that equity, particularly infrastructure equity, was expensive. In 2008, second half, it was difficult to explain to people why they should be investing in equity. And in 2009, till the election happened, not 1 rupee came into Indian equity mutual fund industry. So after that experience, I realized that we as a mutual fund have a role to create products where we do the selling in the scheme in which the investor is invested, and we have spent a lot of time in those products like balanced advantage fund, dynamic, etc. And I think that experience has been extremely good, if you ask me, because it has basically put the burden on booking profits on us, and the burden of buying in periods like Jan, Feb on us. And I've been actually very happy with that experience.